All right, let's talk retirement savings. You know the usual suspects, right? The 401k, the IRA, they get all the attention. But what if I told you there's this sleeper account out there, one that's hiding in plain sight, that could actually be the most powerful retirement tool you've got? We're talking about the health savings account.
So why should this even be on your radar? Well, it all boils down to this one kind of terrifying number. Fidelity crunched the numbers for 2025, and they estimate that the average 65-year-old is going to need this much in after-tax dollars just for healthcare when they retire. I mean, look at that. That's a huge number, and it's the kind of thing that can totally derail even the most carefully planned retirement. And that leads to the million-dollar question, right? How in the world are you supposed to save for an expense that big and unpredictable? Is there a smarter way to do it? A way to make your money work harder? Well, you bet there is.
This is where the health savings account, the HSA, comes into the picture. It was literally built from the ground up to solve this exact problem. You shouldn't think of it as just another savings account. It's more like a specialized, supercharged financial tool for anyone who has a high-deductible health plan.
So what is an HSA, really? Okay, at its heart, it's a tax-free piggy bank you can use for medical stuff. The catch? You have to have a certain kind of health insurance to get one. A high-deductible health plan, or HDHP. You know, the ones that usually have lower monthly payments. But here's the absolute game changer. The money in an HSA is yours, forever. It doesn't expire at the end of the year, it just keeps rolling over and growing. Okay, now we're getting to the good stuff. The HSA's superpower. Seriously. It has this feature that is so ridiculously powerful, no other savings or retirement account in the entire country can touch it. And it's all about something called the triple tax advantage. Let's break this down. It's pretty amazing. Step 1, the money you put in, it's tax deductible. Boom, that lowers your taxable income for the year, so you save on taxes right away. Step 2, the money in the account can grow, either through interest or investments, and that growth is 100% tax-free. And step 3, when you pull money out for medical expenses, we're talking doctor bills, prescriptions, you name it, those withdrawals are, you guessed it, also completely tax-free. So tax-free going in, tax-free growth, and tax-free coming out. It's the whole shebang. Now, to really see why this is such a big deal, let's put it side by side with the accounts you already know, like a 401k or a traditional IRA. With those, sure, you get a tax break when you put money in, and it grows tax-deferred. But, and this is the huge but, when you take that money out in retirement, you get hit with income taxes. With an HSA, as long as you're using it for medical costs, those withdrawals are tax-free. That is a massive, massive difference over time. But believe it or not, everything we've talked about so far is just part of the story. The HSA has this secret identity that only comes out later in life. It's a twist that completely changes the game. This is it. The moment you hit 65, the rulebook for your HSA basically gets a massive update. It unlocks this whole new level of flexibility, and honestly, it transforms into one of the best all-around retirement accounts you can have. So check this out. Before you're 65, if you pull money out for anything that's not a medical expense, you have to pay income tax on it, plus a pretty nasty 20% penalty. Ouch! But look what happens after age 65. For medical stuff, it's still totally tax-free. But for other expenses, that 20% penalty, poof, it's gone. You'll still pay regular income tax on it, just like you would with a 401k, but there's no extra penalty. Yeah, this quote really nails it. Think about it like this. Your HSA becomes this amazing hybrid account. It's still, without a doubt, the best possible way to pay for medical bills tax-free. But for everything else you want to do in retirement, travel, spoil the grandkids, whatever, it just acts like a traditional IRA. It's the best of both worlds, all in one account. Okay, ready to level up? Let's talk about an advanced strategy. It's called the Shoebox method. This is for people who really want to squeeze every last drop of value out of their HSA by focusing on long-term, tax-free growth.
So here's the play-by-play. Step 1. If you can swing it financially, pay for your current medical bills out of your own pocket, not from your HSA. Step 2, and this is crucial, save all the receipts. Whether you stash them in an actual shoebox or a digital folder, just save them. Step 3, you just let your HSA money sit there, invested, growing completely tax-free for years, maybe even decades. Then, step 4, down the road in retirement, when you need cash, you can reimburse yourself for all those old expenses. You just add up your receipts and pull that exact amount out of your HSA, 100% tax-free. It's an incredible way to let your investments compound.
All right, so the rules of the game. As you'd expect with something this good, there are a few rules you gotta play by. Let's run through the big ones so you know exactly what to do. So, who can even get one of these? Well, the rules are pretty simple. Number 1, you absolutely have to be covered by a high-deductible health plan. That's the main gatekeeper. Also, you can't be on Medicare yet. We'll come back to that, it's important. And finally, you can't be claimed as a dependent on somebody else's tax return. That's pretty much it.
Okay, let's talk numbers. How much can you actually contribute? For 2026, if you have self-only coverage, you can put in up to $4,400. If you've got family coverage, that number jumps way up to $8,750. And there's a nice little bonus, too. Once you hit age 55, you can throw in an extra $1,000 a year as a catch-up contribution.
Okay, listen up, because this next part is maybe the most critical rule of all, especially as you get closer to retirement. The day you sign up for Medicare, any part of it, you have to stop putting money into your HSA. And here's the tricky part that catches a lot of people. Medicare enrollment can actually be backdated by up to 6 months. So to be safe and avoid penalties, you really need to stop your HSA contributions a good 6 months before you plan to enroll.
So, let's wrap this up with the key takeaways. What do you really need to remember? First, the HSA has that one-of-a-kind triple tax advantage. Nobody else has it. Second, it's an amazing way to invest and save for healthcare and retirement. Third, once you hit 65, it becomes this super flexible retirement account where the penalty for non-medical withdrawals just vanishes. And finally, if you get clever with it, strategies like the Shoebox method can totally turbocharge its growth.
At the end of the day, the HSA is a healthcare account that's moonlighting as one of the absolute best retirement tools available. It's powerful, it's flexible, and it's crazy tax efficient. So the real question is, are you using it to its full potential?